In financial year 2022, business was rocked with COVID-induced absenteeism, supply chain hemorrhages, war, and the threat of global recession. Despite those challenges, overall, company profits surged as we emerged from pandemic life.
The results were generally good, admittedly all through the rear window. We're looking back at the past 12 months of profits, not what's currently going on now.
Some big names posted some big numbers. BHP recorded a $30.9 billion profit. That includes its petroleum business, which has now been split off to Woodside. The oil and gas giants made half-year profits of more than $1 billion. And high energy prices because of Russia's war in Ukraine also saw Whitehaven Coal post a spectacular turnaround from its loss in 2021. Logistics technology firm WiseTech was up, as was retailer JB Hi-Fi. But some companies that were once beneficiaries of COVID lockdowns didn't fare so well.
Whether it's Redbubble or Adore Beauty, most of those companies are now loss-making again like they were in the pre-COVID years.
The losers are clear. The working from home trade is falling away. I'd also argue that the travel trade is moving away.
Qantas roughly halved its loss to $860 million. And online retailer Kogan, once a winner of lockdown life, recorded a loss of $35 million. More companies are expected to have a tougher 2023.
Given all of the headwinds that the economy is now faced with, so you've got persistent supply chain bottlenecks, we've got ongoing geopolitical tensions and persistent weather problems, particularly on the east coast of Australia, I really think it will be a challenge for, in aggregate, companies to meet their historic benchmark of 5.5% earnings growth this year.
But few were prepared to be frank about their concerns for the months ahead.
We don't have a huge amount of forward guidance. And if it is, it's a statement, it's not actually physical numbers. And a lot of companies are just completely foregone giving any form of outlook.
Their caution showed up in payments to shareholders, with total dividends down 6% to $42 billion, as 27% of the top 200 companies cut their dividends.
Fortescue and Rio, though, they held some of the money back. The banks are also meeting investors with lower payout ratios.
Some economic pressure points have already revealed themselves. The housing market downturn saw building materials maker James Hardie Industries lower its full-year profit forecast guidance by $90 million. Bendigo and Adelaide Bank's profit also fell 7%.
They are showing you through their actuals what to expect from everywhere else in the coming financial year. And unfortunately, it is looking quite negative from the point of view that clearly we are going to slow down.
With the economy set to keep slowing, consumers and ultimately businesses and their shareholders are yet to feel the full effect.
I think it is still highly uncertain as to what the economy is going to look like 12 months down the track. That is largely dependent on what happens on the inflation and interest rate side of things.
An anxious year awaits.